Credit scoring is a crucial part of determining whether borrowers are worthy of a loan. AI can help lenders assess risk more accurately by analyzing data that is not included in traditional credit scores. The problem with most AI credit scoring systems is that they naively throw in a lot of new data sources without knowing how it will affect their models. This can result in inaccurate and unusable scores. Improved accuracy. AI-based credit scoring methods can be used to better understand the creditworthiness of potential borrowers. These systems can use a variety of factors including real-time indicators of income and employment, as well as Google Analytics and online behavior to evaluate a person's financial situation. This can help a bank to make an accurate decision about whether a person is eligible for a loan or not. Although AI can improve credit scoring, there are also some risks involved with its implementation. For instance, it could lead to increased discrimination against disadvantaged groups of people. This is a problem that has long been considered a major challenge in the credit scoring industry, and it's something that has led to new policies and regulations aimed at mitigating this risk. To protect consumers, some credit scoring companies use artificial intelligence to analyze large amounts of data and identify patterns that can indicate how a customer might behave. These methods can also be used to determine how a person will respond to credit incentives, as well as other factors that might affect their creditworthiness. However, it's important to note that AI can be tripped up by noisy data, which can make it difficult for AI models to predict a borrower's likelihood of defaulting on their loans. This is especially true for lower-income and minority borrowers. One way to mitigate these risks is to ensure that AI models are explainable and interpretable. This means that a lender should have a thorough understanding of how the model arrived at its credit score and how it can be applied to specific customers. Similarly, financial regulators should also be aware of the risks associated with using artificial intelligence to assess creditworthiness. In particular, they should be able to evaluate the accuracy of AI models against existing standards for fairness and predictability. To avoid these issues, banks should only rely on AI solutions that have been carefully designed to include only regulated data sources. This includes data that is permitted by law in the jurisdiction where it is being used, and that has been consented by the consumer. Increased flexibility. If AI can be used to improve credit scoring, it could help millions of people get access to financing. This would enable them to buy homes and start businesses. It would also help banks and creditors increase their profits, allowing them to pay back loans faster. One of the ways that AI can be used to improve credit scoring is by providing a more individualized credit score, based on an array of additional real-time factors. This allows banks and credit card companies to assess each borrower's risk level more accurately, and provides them with the opportunity to extend more lending products to people who have been rejected under the traditional credit scoring model. Another way that AI can be used to improve credit scoring involves reducing human error. If a credit scoring algorithm is able to detect when a person has missed a payment, for example, it can automatically alert the lender. This can reduce the amount of time that a loan application takes and increase the speed at which loans are approved. It can also help lenders make more accurate risk assessments and reduce the amount of bias that they have. This can ensure that the bank does not approve any loans that it shouldn't. In addition, AI can be used to increase flexibility in the credit scoring process. This can be done by analyzing data for accuracy, reducing bias, automating tasks, and personalizing the lending experience. This can be done by using a machine learning model that is continuously improving itself as it analyzes new data. This can allow a self-learning model to provide credit scores that are far more accurate than those provided by a traditional credit scoring model. Furthermore, AI can be used to reduce the amount of time that it takes for a credit application to be processed. This can be achieved by automating the loan application process through chatbots and other tools that are able to provide instant feedback on the application. AI can also be used to improve credit scoring by leveraging alternative data such as social media posts and internet activity. This can allow banks and credit card companies to assess a potential borrower's likelihood of paying back the loan. Reduced human error. AI can help reduce human error when scoring credit by using algorithms to crunch huge data sets that may contain information about customers that would otherwise be unavailable. This can include information about their spending behavior, employment history, and groups they belong to. Another way that AI can reduce human error is by reducing bias in the algorithms that are used to score credit. This is an important issue because it can lead to discrimination and other problems. For example, a recent study by Blattner and Nelson found that credit scores were less accurate for people in low-income or minority households than for others. They also discovered that credit score companies had a tendency to overstate the risk of minority borrowers, even when they adjusted for bias. This meant that the standard credit score approach was more likely to overstate the risk of minority applicants than it was for non-minority borrowers, and that this was because the data used in these algorithms was noisy. These results were surprising because they showed that the data used in credit score algorithms is not biased in any way. This is a problem because it can result in inaccurate predictions about how likely someone is to default on their loans. The authors used AI to crunch anonymized consumer credit data on 50 million people, as well as a large marketing dataset that makes it possible to identify borrowers by their income and race or ethnicity. These data were then used to adjust the algorithms for bias and to test how accurate they were at predicting default risk. In addition, the researchers studied data on rejected mortgage applications and found that a typical credit score approach was more likely to underestimate the risk of a mortgage loan applicant who was Black than it was for a white applicant. This is because Black and Latin American borrowers are more likely to be denied for mortgages than white borrowers are. This finding raises important questions about the social acceptability of credit scoring algorithms that use big data and AI. For instance, if algorithms were shown to be biased against borrowers with lower household incomes, they might encourage people to restrict their connections to other borrowers or to favor contacts with members of socio-professional categories that are more likely to survive job loss, as Wei et al., 2016, point out. Increased efficiency. Credit scoring is a process that relies on models and experts to determine whether or not an individual or business can pay back a loan. AI is now making this process more efficient by providing lenders with sophisticated models that allow them to make accurate credit decisions without having to hire an expert. This increased efficiency can be a benefit to lenders in a variety of ways. For example, it can help them increase profits and reduce fees. It can also improve the quality of their lending by allowing them to better assess their borrowers' risk. Another way that AI can improve efficiency when scoring credit is by using machine learning to identify hidden relationships in a data set. These relationships are hard to spot by traditional systems that only look at one variable at a time. However, AI can be used to find these relationships in a matter of seconds. This can save a lot of time and money by ensuring that the lender makes the right decisions about a potential borrower's creditworthiness. There are several different companies that offer AI-based credit scoring applications to banks and other creditors looking to improve their processes. These AI-powered tools are able to use proprietary data to predict a potential borrower's ability and willingness to pay for loans. This allows the lender to more accurately evaluate their risk and provide more borrowers with access to credit. The use of AI to improve credit scoring is a promising development that could have both economic and social benefits. It can help banks to increase their profit margins, and it can also give more people access to credit. Credit scoring is a vital function for many banks and other financial institutions. It enables them to offer services that would otherwise be unaffordable, such as loans or mortgages. However, some critics argue that AI-based credit scoring systems can be biased towards certain groups of borrowers. This can negatively affect those borrowers who may be low-income or minorities. These concerns have led to a number of initiatives to address this issue, including the use of big data to boost credit scores. In addition to this, many researchers have found that artificial intelligence can help to uncover weak signals in the data that are not detectable by traditional credit scoring systems.